Open for Business on CNA 938.
Berkshire Hathaway held its annual shareholder meeting in Omaha, Nebraska, and its CEO Warren Buffett picked the very final minute of that gathering to drop a bombshell. The Oracle of Omaha is stepping down. Well, it was an anticipated announcement from the 94-year-old. He is 94. But the news still came as a surprise to shareholders who were present and even to his own handpicked successor, Greg Abel. He's not only the savviest investor of our time, Mr. Buffett, but he also built Berkshire Hathaway from a failing business into a $1 trillion company today.
Under him, Berkshire's annualized shareholder return has roughly doubled that of the S&P 500. Now, the company has close to 200 businesses, including Geico Car Insurance, the BNSF Railroad, industrial and chemical companies, utilities, and even the Dairy Queen ice cream. So what will Berkshire Hathaway look like without Warren Buffett? Well, let's get the thoughts of Thomas Hayes, Chairman and Managing Member at Great Hill Capital. Thomas, thank you for setting aside time to speak with us this morning on Open for Business. We have to ask you first, did the announcement come as a shock to you, even though we all knew he'd step down at some point?
Yeah, we just didn't think he would be stepping down vertically. We thought it would be when he was horizontal. So I think it was quite a bit of a surprise for everyone. Absolutely the greatest investor in the world of all time. And to your point, 5.5 million% return since 1965 versus the S&P of 40,000, give or take. In English, that just means he did about 19.9% per year for 60 years, and the S&P did 10.4. And it was less the great decisions that he made than the big problems he avoided. You know, I remember the covers of Forbes and other magazines in 1999 and 2000 when they all asked, did Warren Buffett lose his touch because he wasn't investing in tech stocks and he was buying all these value stocks and these boring companies? And then the next couple of years came when the NASDAQ fell some 80-90%, and Buffett was up for the next 3-4 years and laughing all the way to the bank. But that's Warren, and he never took victory laps. He just let his actions speak for themselves.
So obviously you're a big fan of Warren Buffett. I mean, no surprises there. I am as well. How did you react, though, when he announced Greg Abel as his successor?
Well, listen, Greg is an incredible business operator, but, you know, it's kind of like Taylor Swift and her band. When Taylor steps down, how many people are going to show up to watch the band? I mean, he's built an incredible conglomerate. It's a very solid, rock solid business, but without Warren, it kind of loses that magic touch. And I would estimate on a go forward basis, you're effectively got a compilation of businesses like Haryanto was referring to, 180 some businesses. It kind of represents the S&P 500. Unless you saw some transformative or see some transformative deal to sop up some of that $350 billion of cash before he passes. Once he does pass, I think there's going to be a lot of noise to start to issue dividends, to break up the company, some of the parts. They won't do that because he's probably taken every possible action he can to prevent them from doing that. But that's really going to be the story. And without the Apple investment, the performance the last 20 years, because the law of large numbers was a lot more muted than obviously the first 40 years before that. And that's just by nature, $1.1 trillion business now, $350 billion of cash. It's going to be much harder to move the needle and have that level of outperformance moving forward. And the one thing that no one's been talking about this weekend, Andrea and Haryanto, is one of the huge moneymakers besides Warren's stock and business picking ability was Ajit's underwriting ability. And Ajit is getting up there in age. And he was responsible for creating all that free investment float from the insurance premium. And he will be very, very, very difficult to replicate as well. I mean, Buffett had joked over the years, if you have a choice kind of if there's a safety raft on a boat and one person can fit, make sure you put a Jeep in the raft and leave me on the sinking ship, because a Jeep has been a major, major moneymaker over the decade.
Thomas, Berkshire without Buffett is a theme that's going around because that's just how synonymous the two are. Some investors, they worry about the future of the company without the Buffett magic through Greg Abel. What will Berkshire's board, as well as Mr. Buffett and Mr. Abel, need to do to, I suppose, convince investors that the company is in safe hands?
Well, look, I think Greg Abel is a competent operator. Todd and Ted at the investment wheel. We didn't really get they weren't brought out to the forefront as much. So I think investors don't really know what to think of their investment ability. Obviously, Buffett has huge confidence in them, or they wouldn't be in that position, and they wouldn't have continued in that position, and they're very smart investors. But the Buffett magic touch is a whole different story. And I think in order to move the needle beyond basically being a proxy for the S&P 500 post Buffett, a real transformative business deal needs to be done before Buffett passes. And you look at the ones that they've done in the past, whether it was Mid-American Energy in 2000, they paid $2 billion. That's where they got Greg Abel from. Or Burlington Northern Santa Fe Railroad in 2010, he bought that for $26 billion. They really need a needle mover to kind of give investors the idea that this can continue to have outperformance, because that 2% outperformance for the last decade, which is very impressive, was largely attributed to the investment in Apple. So they're really going to need something like that. Otherwise, you just have to accept it's a $1.1 trillion company, hard to grow at 20% a year at that level, and just effectively, take a choice, whether it's the S&P or Berkshire. You're probably going to get similar type of returns over the next decade.
Well, Buffett seems to think that Abel has what it takes to get there, or even take Berkshire Hathaway even beyond that. But the thing is, he's also inheriting the company at a really tough time in the American economy, so to speak, with Mr. Trump and his tariff policies, among many other things that are weighing on Americans right now. How will his challenges differ from that of Warren Buffett's, say? I mean, it's hard to beat, like you say, 60 years of returns at 20% or more. I mean, it's going to be a tough call for Mr. Abel, given the current environment he's in, do you think?
Well, look, I mean, if your boss set you up with $350 billion of cash, you'd have to work really hard to screw it up. He's got an awful lot of cushion and awful lot of optionality to make good things happen. And I think he's certainly a competent operator. As it relates to tough times in the U.S., I think that's a very difficult statement to justify based on the numbers presently. We just came off earnings season. We had 12.8% earnings growth. The negative GDP headline that people are referencing was a lot of pull forward from imports, C plus I plus G plus X being net exports. That took off about 3 percentage points. So barring that pull forward, we basically had 3% economic growth. Now, if we go another 2-3 months with no reasonable trade deals, then we could potentially have a problem. And honestly, given Berkshire's cash position, that would be the best thing ever that could happen to Berkshire. But I really don't foresee it happening. What we've seen so far is we have a Trump put. They've shown flexibility to pause. They've shown flexibility with different industries, the auto industry, to do certain carve-outs for the auto suppliers. And the rigidity that started with quote unquote Liberation Day has kind of ameliorated. So that's given the market some level of comfort. Earnings guidance, while it's come down about 3.6% for 2025, it's held in for 2026 at $302 on the S&P, which implies we're trading at about 18.5 times next year's earnings compared to the 10-year average of 18.3 times. So the economy is generally strong, which is kind of their problem. Unless things get really bad, they're going to have a hard time finding a big enough business to buy to move the needle at good prices. And that's been the problem for a long time. Much easier to find smaller subscale businesses when you're running 10 or 20 or $30 billion than when you got a $1.1 trillion company. So the days of the little one-offs like See's Candy and Dairy Queen and the gas stations and Hellsberg Diamonds and Omaha Furniture Mart are behind them. They really need something big, and it's hard to say that that's in the immediate future.
Yeah, he's got not just big shoes to fill, but a pretty challenging front to tackle as well. Thomas, we'll leave it there. It's the end of an era, start of a new one, hopefully, for Berkshire Hathaway. Thomas, it's been great to have you to chat with us this morning. Really appreciate it, and surely not going to be our last one with you.
Thank you very much, Andrea. I appreciate it, and Haryanto as well.
That's Thomas Hayes. He's chairman and managing member at Great Hill Capital.